Okay, good afternoon, everybody. Firstly, may I take the opportunity to thank Marine Money and the team, to also the sponsors, Suede Kessel, Transport Capital, and of course Standard Chartered. I'd also like to thank all of you who have attended today, particularly because I've spent the last 14 days serving my SHN quarantine, so it's great to see so many new faces today. So today I'm going to be looking at the three markets. These are There we go. I'm going to be looking at the three markets: tankers, bulkers, and containers. And within this, we're going to be covering values, positions cyclically today, how charter rates have changed over the last 12 months, the demand versus supply balance, and where we are going forwards. At the end, I will then summarize which of the ship types the data shows are likely to have the best future. So for today's assessment, we're going to use the metaphor of the weather to denote the position of each of the respective markets. For the sake of clarity, sunshine being positive and the rain clouds being negative. Just a note that all of the data and analysis that we'll be looking at today is covered by our usual disclaimers. Okay, so first just a little bit about VesselsValue. I know a lot of you do know us, but for those of you who don't, we were launched back in 2011 with 5 founding members. We're now over 180 strong across 8 offices worldwide, most recently opening in Hong Kong. Our database is based on 4 pillars of values, database. These are both commercial and technical, mapping and tracking, and also trade analytics. These are utilized across the market by financiers, ship owners, operators, governmental bodies, and professional services. It's great to see some of you here today. So we're going to look at the bulker market first, and I'll spend a little bit longer while we look over this, just so you can understand the analysis. Then when we get to the container and tanker markets, I can run through it a little bit quicker. So here we're looking at, here we are looking at the 5-year-old vessels across all of the major bulker types, but with a focus on the absolute and percentage changes over the last 12 months, as signified by the black line. There looks to be positivity across the dry bulk market at the moment, strengthening values in the Capesize market, namely due to strong demand from China, with steel production continuing to increase, but also in the smaller asset types, Handymax being the biggest winner here. We can see a 5-year-old Handy in August 2020 was valued at 11.5 million, the same asset today sitting at just over 20 million. Again, this is caused by increased demand from China for other goods such as grain and soybeans. Looking more closely at the last 3 months, we can see there's been continued improvement in asset values across the sector. As we continue to recover from the effects of COVID-19, we can see that Handys again are leading the charge over the last 3 months. Okay, so now looking cyclically, what we are showing here is 5-year-old vessels in different ship types against the 30-year historical median, removing depreciation. So for example, Suezmax, which we saw in the last slide, have increased 72% in the last 12 months, and their current value sits 48% above the historical median. In the short term, this is looking positive. Strong values equals a strong market, better profits. However, we all know the market is cyclical, and as you can see from the previous and remaining slides, the future is looking positive. That being said, with the values so much higher than the historical median, there has to be some downside risk over the long term. Okay, so now we're going to look at the supply and demand balance. Firstly, looking at the Capesize market. So looking at the underlying supply and demand fundamentals here, this chart is showing quarterly changes in fleet growth for Capesize, which is shown by the orange bars, compared with the quarterly changes in AIS-derived cargo mile demand, which is shown by the black bars. So for example, in the most recent quarter, you can see the black bar is above the orange bar, showing excess of demand growth, which is one of the reasons we're experiencing such a strong market today. The beginning of 2020 was a pretty bleak outlook for the Capesize market, with steady vessel growth and declining cargo demand as a result of COVID-19 restrictions. However, in the first half of this year, we can see the market has picked up. The main reason for this being persistently strong iron ore exports from both Australia and Brazil. So that was an overview for the Capesize market, but for the sake of timing in this presentation, I'm going to look at the same analysis across all of the major dry bulk types over the last year. So once again, the black bars showing demand change and the orange bars showing supply changes. So for example, handy bulker demand growth here has exceeded supply growth by 4.2% in the last year. You can see all the other asset types show the same trends of demand growth exceeding supply, showing the strong underlying market fundamentals for the dry bulk market. So as a result of all of the increased demand for dry bulk goods and the reduced availability of tonnage, we can see that the bulker charter rates have also seen significant increases. The biggest winner here in the last 3 months being Supramax, with a 50% increase. So what do we see going forwards in the dry bulk market? Well, our forecasting partners, VMR, have looked at the market fundamentals and they've provided quarterly updated forecasts, which are also available on VesselsValue. These are showing the expected increase in values for fixed-age 5-year-old vessels. For example, their forecasts are most bullish for handies, which are expected to increase another 35% by the end of the year and max out at a 47% increase at the end of 2024. VMR expect demand to outpace supply for the next 4 years, and this should lead to a tighter market balance and significantly increased freight rates across all vessel segments. This gives us a positive sunny indicator for bulker forecasts. Okay, so now we understand how the analysis works. I'm going to whip through on containers and tankers as well. So on to the biggest success story of the last 12 months. Containers are scorching hot right now. We can see there have been unprecedented increase in values across all ship types. For example, Panamax have seen a 439% increase in the last 12 months alone. We've seen owners like MSC have worked out that it's more cost effective to actually purchase a vessel than to charter. One example being the Mexico, a 5,000 TEU container ship, sold for $50.5 million at the end of June. The equivalent vessel on a 5-year charter would be up to $70 million at today's rates. Okay, so we can see, looking now at the last 3 months, the rates are still continuing to firm. Again, this is due to increased US imports, port congestion, shortage of capacity. These are all contributing factors to why we're seeing such a strong market today for containers. However, all of this positivity in the current market may indicate some rainy days ahead. As with bulkers, values across the container sector are exceeding the 30-year historical average, best performing asset here being the feeder max, exceeding the historical median by 155%. Again, this would suggest there may be some downside risk in the long term. So, apologies, there we go. Looking at the data, we can see that again, the cargo mile growth is exceeding the supply across all asset types. Handy container demand exceeding vessel supply by 3.2% in the last year. Steady cargo mile growth and stability on the supply side, again showing strong market fundamentals for the container market. So now looking at the charter rates, we've seen unprecedented levels increases in charter rates over the last 12 months, and unsurprisingly, Panamax being the biggest winner, as we saw with asset values as well. You know, this is all to do with the relief of pent-up demand for consumer goods following COVID-19 and significant congestion and supply chain delays, which have contributed to the stark improvements in these rates. If we look forward, there's few signs of the market conditions easing before late 2021. We're going to continue to see these supply chain disruptions and congestion having an effect on the market, and this is taking longer than we'd expected. However, looking into 2022, we can see rates are going to start to ease up, supply chain disruptions and container availability will resolve. So there's short-term positivity in the sector. However, looking to the long term, we're going to give this a rainy indicator. This is mainly due to new ships entering the market at the start of 2023. So on to tankers. So August 2020 saw tanker values continue to stabilize following the contango, driven by massive oversupply of oil and huge demand for floating storage, sending tanker values through the roof. That being said, in the first half of 2021, tanker values have started to creep up. We can see that VLCC values have increased 3% since the same point last year. This is largely due to tonnage oversupply and a reluctance to scrap the vessels with ever-firming steel prices. Looking to the next 3 months, we can see values are continuing to firm up, Suezmax having the biggest increase of 7%. So where does that leave us cyclically on tankers? Well, against the 30-year historical average, we can see the tanker market has been underperforming, particularly in the smaller sizes. The worst performing asset type here being Aframax, sitting 6.5% below the historical average. So this is not looking particularly good in the short term. However, it does indicate potential upside in the long term. Shortly, I'll show VMR's forecast, and we can see if this lines up. On to supply and demand. We can see that the VLCC market has seen a drop of 12.5% against supply. The downturn in floating storage due to OPEC cuts, also coupled with COVID's impact on international travel, has caused the world's oil demand to fall considerably. This, coupled with a resurgence in the virus and also further lockdowns continuing on the poor streak. This has also trickled into the clean market, and we can see with cuts in refining and again international travel at a standstill, jet fuel consumption remains at all-time lows. Over the same period, we've also seen increases in vessel supply, only adding to the rainy outlook for this tanker sector. So unsurprisingly, because of this falling demand for crude oil and clean products, coupled with oversupply in the tanker market, we've seen unprecedented lows across all sectors here. VLCC rates have been particularly weak, dropping 9% in the last 3 months alone. So we're going to give a negative rainy figure here for the last 3 months on charter rates. But what about the future? So in the short term, there looks to be some positivity across the market. VMR are suggesting we may see rates fall off a little bit in the medium term. However, there looks to be long-term prosperity for the sector. VLCC is having the biggest long-term improvement, maxing out with a 17.8% increase by the end of 2024. So we're going to give a cloudy, cautious look in the short term, but positive times ahead, sunny times ahead for tankers. So what does this all tell us? Across the tanker market, we've seen values start to creep up. Demand is still lacking in comparison to vessel supply. However, with the world opening up post-COVID, the long-term forecast data looks good. In the words of Frank Sinatra, the best is yet to come. Bulkers are looking very strong. Values are up. We have strong underlying market fundamentals in supply and demand, and the forecast is looking positive. And in containers, the short term is still looking strong. However, with a boom in rates and values, some of the data shows there might be some downside risk in the long term. So from today's assessment, we can see that the most promising sector is the bulkers, and the outlook is pretty sunny too. Thank you very much. Thank you.